right. Hello, everyone. We'll get ourselves going here. Thank you for joining us today for our second quarterly webinar of the year. We've got Jeff that will be presenting his review of what's happened the last first half of the year, expectations for the second half of the year. You will have an opportunity to ask questions after Jeff's presentation. Two ways you'll be able to ask a question. One is you can raise your hand and we'll unmute you and give you a chance to ask the question. Or if you prefer, you can type the question into the chat as we will be monitoring that as well. And with that, I will hand it over to Jeff.
Thanks, Anissa. Everyone can hear me okay? Sounds good?
Yes, we can.
Perfect, thank you. Yeah, so for those who are able to join in summer, thank you. I think you'll have this for a recording on our website as well, so that people can review it. And I think we'll have the slides to send out too. So if you have any questions after, certainly you can reach out to me as well. But I'll just this is our second time doing this. We did the last one in April. And we will I guess the next one will probably be our AGM in the fall. So I'm just going to go through sort of a bit on the second quarter, talk about the changes we made in the portfolio, talk about sort of how different pieces of the portfolio have been performing, where we've been doing well, where we can do a bit better and what we're doing about it. And then I'll finish up sort of talking about a bit about sort of some of the economic stuff. So as far as where we think that things are heading and how we're positioning the portfolio, and please, as Anissa said, you can hit the raise hand button there, or just send a message in the chat, and please ask questions at the end, and those always make for the best anyway. So with that, I'll move her on here. Click here, there we go. So just a brief overview. Not a crazy amount of changes for the quarter. We did move a few pieces around, but the net is we've moved more towards sort of a balanced approach. So in the first quarter, we were still a bit underweight equity. We were still performing and keeping up with portfolios that were fully exposed to equity, thanks to how well we've done in fixed income and how well we've done in Canadian equity. But we're now sort of more fully invested, not necessarily overweight, but sort of equal weight to what a typical portfolio would be. And I'll just say when I'm presenting these numbers, I mean, we have we have varying portfolios that we run. We have sort of our balance model, which is your typical 60% equity, 40% fixed income or bonds or cash type portfolio. And that is what about, I'd say, 85% of our clients are invested in. So I use that as sort of a baseline. We do have a more growth-oriented portfolio and a more conservative portfolio. They own the same investments and the performance in the asset categories is the same. But when talking about sort of the overall performance, we use an average of how sort of our average balance clients have done. So getting back to the overview here, again, we're back to sort of a balanced approach. For the quarter, we saw really good performance out of U.S. equities and emerging markets, and I'll talk a bit about that. The TSX, so in Canada for the quarter, it was actually negative, but we weren't, thanks to our investments in the commodity sector, which is doing really well. In the U.S. tech, I mean, everyone's making money in the U.S. right now. I'll talk a bit about just how the U.S. market is rallying and why, and how it's sort of specific to a few companies. We have a couple companies in the U.S. that have been lagging. I'll talk a bit about that. Again, gold, we have about a 7% weighting to gold in our balance model in most of our accounts, and it's just been doing phenomenally well, helping us outperform. And then also talk a bit about fixed income, the investments we have, the changes we've made, and the yield that we're getting on that portfolio. So just as sort of a quick overview, there's a lot of numbers on this slide. I hope everyone can see my cursor, so it helps me point to things. But the major, I'll switch this highlighter here. Actually, no, I want to go back to that. The major parts that pointing out is one in the S&P 500 in the US. Again, a very positive quarter, and then emerging markets in also, beat the US and were sort of the best performing asset class for the second quarter across all these different, I guess, Japanese. We just don't have a lot there, but overall, in the equity markets, certainly the best performing area for the quarter, and again the TSX coming up negative for the quarter, and looking at bonds sort of flattish overall. Weighting wise, this is sort of a graphical view of how our typical portfolio looks on a balanced model, and again we're up to sort of that 60% equity piece and sort of 40% off equity. This is sort of a better breakdown of that. So the Canadian equity, our target for sort of new money coming in is a 26.5% weighting to Canadian equity, 22.5 in the US, 8.5 international, and then we're about 1.5 emerging markets. So a small piece that we may change in the quarter coming up. But overall about 59%, so close to that 60% mark in the equity space. Net changes, this column here for the quarter, we did increase Canadian equity by about 3% by reducing government bonds, and that was our move to the Canadian Bank auto callable note, which we did across almost most portfolios. So adding more exposure to the financial sector in Canada, and increasing our Canadian equity now up to 26.5. And then the other major change was just sort of reducing our preferred share weighting. Preferred shares were down to 7% now. We ended the first quarter at about 10%. It has been an outstanding performer this year. We've had, and I'll get into that when I talk about the fixed income part of the portfolio, but in trading preferred shares for almost 16 years now, coming up in a couple weeks, they tend to do very well, and then they tend to do very poorly, and it's not a smooth ride. And so in my experience, when we've gone through periods where they've had these big rallies, some caution is warranted. So we did move out of preferred shares. We actually increased our cash weighting, and again, that's not so much because we're afraid of the market, but because we're able to get about 4.5% still on cash right now. And it does give us a bit of a wait and see. I did talk about last quarter, leading up to the U.S. election, and certainly it's been a busy week of U.S. election news. But typically what we do see is sort of a flatter, quieter market leading up to the election. And then we would tend to see a rally kind of post-election. So I'll talk a bit about that, probably more in the next update as we get sort of into the fall season. But having a bit more in reserve, I think, is warranted for that. Looking at the performance, how we did. So this is looking at the different asset categories, and how our specific investments, so not the Canadian market as a whole or the US market as a whole, but how our Canadian investments, how our US investments, how our fixed income investments have done, both year to date and then for the quarter. So again, starting in Canada, I talked about Canada was negative for the quarter. We were up about 4% with our Canadian investments. So again, outperforming there by quite a bit. Year to date, we're at about 15.2%, or at 15.2%. We were at the end of June, and I'll compare these to how that compares to the indexes on the upcoming slide. In the US, again, we underperformed this quarter, and I'll talk about that, and or I'll get into that sort of in the economic talk and when I speak about sort of how the US market's been performing, but that's largely because of a few specific technology companies that have really been driving the US returns. But again, sitting at 11% year to date. International equity outside of emerging markets was weaker, was weak this quarter. So we're sitting at, we fell about 3% and currently sitting at -2 on the year. So we were just positive at the end of the first quarter, and now we're sitting a bit negative, and that's basically in line with international as a whole, as I'll talk about. Gold up 6% this quarter. So again, it's just been doing phenomenally well for us. having, there's not a when you talk about sort of what an active portfolio approach would be, you're not really going to find many of your friends probably that have 7% of their portfolio in gold. So, to say, well, I've got 7% of my portfolio in gold and it's up 16% this year, it's pretty awesome. And so when it works, and thankfully it does. We'll have to, obviously keep reviewing that, as inflation is starting to come down, but I do still think gold has a bit of room to run. And I talked about last quarter how, we saw inflation run so much over the last few years and gold really lagged. So I think it's still catching up, and we'll probably still be doing that for a bit. Fixed income, again, pretty flat on the quarter. We were up about 2.5%, so better than flat, sitting about 5.5% halfway through the year. So 5.5% halfway through the year for bonds. That's 6 months, 5.5%. That's 11% over a year. So I don't think we're going to do that, but certainly not losing any performance by being in fixed income. And then looking at sort of the overall portfolio performance, so our average balanced account at the end of June was sitting at about 8.6%. Up until about, I'd say about 10 days ago, we were actually creeping up close to 10 because the start of July was also really strong, and it's been a bit shaky here the last few weeks, so we're probably kind of back to around 8.6. Looking at how we compare to the benchmark. So again, in Canada, some to brag about, some not to. But again, 15.2% is what our Canadian portfolio has done year to date, and that's probably the biggest part of our portfolio compared to the average in Canada for the TSX at about 6%, so outperforming by a large margin. On the flip side of that, US equity in Canadian dollar terms, because as the Canadian dollars weakened off a bit, about 19%, we're at 11, and again, that's largely that 19 has largely been from the 7 largest tech companies, or what's now being called, if you watch BNN and all the financial news, the Magnificent Seven, which is Google, Amazon, Apple, Microsoft, Tesla, Meta, and Nvidia. And these are the sort of the 7 largest companies in the S&P 500. So of the 500 largest companies in the U.S., those 7 are the largest. And I'll get a bit into how much of this 90% has actually come from those companies. And I'll also talk sort of a bit about how those companies have differed themselves as well. International equity, like I said, it's been negative on the year. We're sort of in line performance-wise. Gold, we just own, gold you can't really outperform what gold does. It's gold. And then in the fixed income space, excuse me, sitting again negative, or sort of flat to negative on the year. It was positive on the quarter, 1%. It was negative in the sort of positive in the second quarter, negative in the first quarter, but basically flat, and we're seeing at 5.5. So overall, compared to the average balanced account in Canada, this is before any fees. So just if you just were able to buy the indexes and not pay any sort of cost for that, you'd be sitting at around 7% at the end of June. Our return, again, net of fees, beating that by a good chunk, about almost 2%. Again, I'll go through sort of some of the investments in the portfolio and some of the changes we had. I guess one of the changes in Canada is we did switch from Meg Energy, which had a good run, into Birchcliff. So going from sort of heavy oil to natural gas. Natural gas is, I don't know if it's the cheapest it's ever been, but it's pretty darn close. And so there's a lot of opportunities, especially as some of the LNG projects start getting going off the coast. I think we're going to have, over the next few years, whether those projects start actually producing significant results, or just the excitement building about them. We expect to see gas do well, and certainly Birchcliff was up 18% for the quarter. So we're right so far, 9.5% for the year. But overall, it's sort of ranking these from best to worst year to date. Capstone Copper continues to it's up 52% this year. Not quite as good as Nvidia, which we don't own, but but not bad. You know, so you can't brag with your friends who own NVIDIA, but you can say, well, I own Capstone Copper. It's up 53%. Largely follows the price of copper, which again has done really well. And just a pure copper play, producing mines, safe jurisdictions, Vancouver-based company, which is starting to get more and more notice. So expect to see good things coming from that. I've highlighted the TSX 60 again, and I've done this on all the slides just to kind of show what the benchmark was. Now these numbers are as of June 16th, so this is again, you know, 6 days ago. So they differ from sort of from and when I'm talking about the Q2 number, I'm basing that off Q2 plus a few days, using June 16th, and that's only because I didn't capture the data at the end of the quarter, so I had to cheat a little bit. But this is sort of comparing, you know, all the performance of these Canadian companies. You know, BCE, Fortis, some of the, you know, typical sort of, you know, companies that everyone loves, you know, big dividend companies, haven't been the ones to own this year. Not to say that they won't be next quarter or make a rally back, but they continue to be pressured by higher interest rates. These tend to be companies that have, you know, CN Rail as well. Very, they have a lot of property and equipment and a lot of assets, a lot of debt. So, you know, they have taken it, you know, their costs. They've been more adversely affected, I guess, by higher rates. But we are starting to see rates come down. So, excuse me, we expect to see good things. BCE specifically, you know, they're paying, I think the dividends like over 9% now. You know, there's been some talk about whether they would cut that. I went back like, you know, 30. I went back as far as I could data wise. I don't think I had never found a situation where they cut the dividend in the past. So if they did, that would be a big thing for them. So, you know, we're down 13.7%, but, you know, we're making 9% in dividends. So it's probably offsetting a lot of that drop, which is nice as well. In the US portfolio, so of the Magnificent Seven, we own Google, we own Amazon, we own Apple, we own Microsoft. Google has been the best performer year to date. Interestingly, Costco has had a heck of a good run as well, which, you know, it's never, I guess, surprising when Costco does well, but it does get more and more challenging for them to figure out ways to grow. You know, like the stores, like where they need is like, you know, they got to start having parking lots that stack on top of each other to fit more people in the store. I don't know how they're going to do it, but good to see that that's doing well. You know, looking at the U.S. market on average as of mid-July, and sort of, you know, are the companies that are outperforming and the companies that are underperforming. Disney had sort of a weaker quarter after, I think, a lot of initial excitement. But still, you know, it's still doing okay year to date. And still, you know, a long-term hold for us. I still think that you know, they're coming through their transition period, and with Bob Iger back, you know, he's been back as CEO for, I guess, about 6 months now. I think we give that another couple quarters, and I think we'll start to see some good results out of Disney after, you know, sort of 3 to 4 years of being pretty quiet. You know, the underperformers, the major ones, I guess, would be Estee Lauder and Nike. Kind of both going through company specific issues, so not really anything I'm overly concerned about. I think that from a portfolio perspective, anytime you see, you know, anything dropping that much, you know, it's shocking. But, you know, I guess it's also partly to do with how well, well, certainly in Nike's case, how well they did before. And even though emerging markets are doing really well, this past quarter, they've really struggled in Asia the last year, as China's kind of struggled to come back from COVID still, and are just starting to. So, you know, Nike's they've said they're in a transitional year. You know, their profits have actually been trending positively because of all, one of the big challenges they had, I remember, gosh, this would have been like 6 years ago when they were also struggling, was with shopping centers and people, not going to the mall to buy shoes. And they revamped their whole online process and they were able to, deliver direct to consumer. And now, we don't even think twice about buying stuff directly from companies online, buying stuff from Nike. We all get promos in our email to go on and Black Friday and all that. And so, they've essentially cut out a lot of the middlemen in their business, and they're one of the most recognizable brands in the world. So they'll be fine. Estee Lauder, is a bit more of a frustrating one. They were they could do no wrong kind of a year ago. The stock was like $265. The cosmetic and it's like how do you lose money on like skincare with baby boomers? I don't know. But they're not. They're still doing quite well, but they were sort of priced for perfection as far as some of the expectations of their business went, and they actually got a bit overexcited and built up way too much inventory, and they've been working through that. So that's been sort of a struggle for them. We bought the stock around 150, so after it had come down from 265. It's continued to struggle where since then, again falling from there. But we'll see what we do this quarter. We've looked at some options for it. We do also own L'Oreal, so we have two cosmetic companies. So that's one we might make a move on. But it's always hard to make a decision when to get out of these things. Again, looking at some of the tech companies in the past that we've owned, and you see them fall like 60-70%, and everyone thinks you're crazy to own them, and now they're up like 200-300, right? So they go up and down. So we'll wait and see on that one. In the international portfolio, again for the quarter, emerging markets very strong, 8.3%. Over the past 13 weeks. And sitting at now 14% year to date. Sorry, this should say July 2016. I know it says April. April 16th. That should be July. That's my typo. And in the international portfolio, Nestle, so chocolate, booze, cosmetics, not terrible. Well, not great performance for the quarter or for the year. And they've had sort of similar their major struggles. I guess, well, they've been sort of flat for the quarter as well. Continue to be sort of company specific and sort of how do you grow when you're already that big. And they're working through it. Well, we've owned these companies for a long time. They don't really owe us anything. They've been great performers. They're just kind of going through a period where they gotta figure out their next piece, and they've got some of the smartest people in the world working for them, so they'll figure it out. Fixed income wise, we're looking at again, I've highlighted sort of the bond universe. So if you just own sort of a bond ETF, you'd be sitting at about -1 year to date. And again, this is say July. Some about 2.5% for the quarter. Looking at our fixed income investments year to date, again, those preferred shares. So the Horizons preferred share ETF, the Canoe preferred share ETF is one that we added recently in place of this iShares. So that's why I've highlighted in red. Similar performance between the two, but the Canoe fund, because it's a mutual fund structure, they're able to own both preferred shares and another sort of type of preferred share, although it's sort of replacing preferred shares with financial companies, and I won't get into the details of it, but it's what's called an LRCN, or limited resource capital note. It's essentially a preferred share that banks figured out a way to issue to pay less tax themselves. But it is sort of a safer preferred share. And Canoe's able to own those in their fund structure. So again, with the idea that preferred shares have had this big run up, when I looked back and in the last sort of preferred share down cycles, Canoe's fund held up better. So it's just we made sort of a slide over there. we have the Manulife and the Great West preferred share that we own directly. We also had a Royal Bank preferred share, which we talked about last quarter, which got redeemed. So that also, brought our preferred share weighting down from that coming due as well. But that's really largely driven our outperformance in the fixed income space. Longer term bonds, so getting into like the 20-year plus, we haven't really seen in the U.S. This is a U.S. product. Haven't seen any rate cuts yet in the U.S. Expect to in the fall, and so we do. These are still we're getting a decent yield off them. And I think my next slide shows that, if I'm correct. Yes. So, getting 4.5% yield off of 20-year treasuries. And again, this is an area where when we do see interest rates start to decline, we'll expect to see this number, reverse and see sort of, +5%, +6%, annual returns from long-term bonds as they come back out of the hole that they fell into in early 2023, on top of the yield that we're receiving. So, we see a lot of good things coming from that. Overall, so looking at, these are all the yields on the fixed income investments that we own. Overall, again, I said about 5.1%. So we're getting paid to hold them. We're seeing good performance. And I know when we have, bull markets like we're in right now, I get a lot of flack, people saying, why do we own bonds? Why do we have everything in equity? And I always say, it's all about trying to make the most money with the least risk as possible. We're keeping up, and, let me do my thing over here. I'll try to make fixed income do as best I can. So getting into shifting gears into the economic perspective, and again, happy to start talk about any specific companies if we have time after. But sort of looking ahead at the economy, and talking about sort of where we're at and where we're going. The U.S. economy or the U.S. market has really defied all the odds, and I say that in the sense that we've been calling for a recession for almost a year now, and we haven't seen one. The market just continues to grow on this idea that the Federal Reserve has sort of perfectly brought inflation down under control. Has brought rates up the perfect amount so as not to create a massive spike in unemployment, so as not to collapse the economy. But it's just this idea that there has been this perfection, and whether or not it's true, the market believes it's true, and so it's doing well. And it does look like, when you look at the inflation numbers, you can't argue with it, right? Like the prices have basically have stabilized, and we're seeing back to sort of that 2% annual inflation range, which is in line with the target. So again, that does suggest we'll certainly see rates coming down, and we certainly expect to see the U.S. and Canada cut rates pretty aggressively in 2025, because you can't really keep rates high if inflation's not running. We'll get deflation then, and we don't want that. So again, I'll talk about the momentum of the market. So it does tend to be when things are doing well, they do tend to continue to do well. So talk a bit about that. I'll talk about U.S. tech specifically, because I think that's such an interesting thing right now, and it has been for the last few months. And just talking about sort of our approach, and how again, this idea that we have the flexibility in our models, and I get questions all the time. Oh, should we buy more equity? Should we? Like, what? My job is to make as much money as possible for the least amount of risk as possible. If I think I can do that with owning more equity, I will. If I don't, then I won't. So getting into some of the charts, the first one's just, again, just a graphical view of how things are going. So basing it off the start of the year, bonds have, sort of been flat, although again, we've done better because of our preferred shares. The U.S. stock market has, went through a bit of a dip in the spring, but it's gone on this sort of late surge again in the sort of the second half of the year. And again, largely because inflation's coming down. So we've had year-over-year inflation in the U.S. So looking back, July, looking back a year ago to July, where prices are at, before in 2023, when we really saw, when we saw a bear market, um, last year, or sorry, I guess 2022 and 2023, we saw inflation at like 7%. Now we're down to about 3.4. And when we're looking at month over month, so July compared to June, or we're seeing that come back down to this sort of 0.2% per month, or around this 2% annual level. So very much in line with exactly where the powers that be that control rates wanted to be in the U.S. and Canada's numbers are actually even lower than this, which is why we expect to see rates in Canada certainly come down as well. This, talking again about the market performance, really defying the odds. This is sort of looking at all the bear markets, so all the stock market sort of crashes going back to 1968. So this is sort of 60 years of stock market history. Obviously 2007, 2009, people remember that one. That was fun. The tech bubble, that was also a good time. COVID. And then this was our 2022 market crash, when we had interest rates spike up unexpectedly. Pretty much all of these incidents, with the exception of the 1987 sort of swift Black Monday crash, if people remember that, we saw a recession, and so we haven't seen one yet, which is strange, although it's not unprecedented. And then the other, I guess, major part to point out is when we look at the duration, so how long it took from these crashes, so these bear markets, to come out of that bear market, which we've now come out of that bear market. We're now in a bull market. That took 24 months, and in every other instance where we came out of a bear market, there was an interest rate cut, was the last move that was made. So the bear market, we came out of a bear market, thanks to some Federal Reserve stimulus, and we are out, and that hasn't happened yet. So that is a sort of a first, or at least in the last 60 years. So what does that mean? It means that there is a lot of market positivity. I think that cuts have sort of been because rates were taken up so quickly. We certainly expect cuts, so it's almost like, well, they're going to happen, so it doesn't. It's just kind of a weird idiosyncrasy, but it's worth noting, and it also I guess can be seen as a positive, in that if we do see cuts, we could see the market improve even more. I guess on the flip side, though, if we get surprises, then there is some caution warranted, and that's probably why, again, this balanced approach is important, because there is a bit of perfection priced in. Looking at I guess this is another way to look at or examine sort of how this is kind of strange. These are sort of our last major interest rate hikes. So in the 80s, in the 2000s, late 90s, where we saw interest rates really just shoot up to combat inflation. And then these gray bars are recessions. And so we saw leading up to COVID, we started to see rates increase, and then they obviously cut them back to zero. Had a small recession there. Massive spike up, obviously, in 2022 and 2023. No recession yet. So again, I think that's just interesting to see, and again, why I think caution is warranted. The major reason, again, why I think I've talked about this in the past, why the market's done so well is we had this massive spending spree that came post-pandemic. So we had a period where people were really saving, couldn't really do much, and we saw even so sort of like inflation adjusted spending has been on this, let's call it a trend line. When you add inflation in and look at how much more expensive stuff has been, on the red line here, people have fully absorbed that higher cost. Like people, there hasn't really been a slowdown in spending, and so I think that's also why maybe this is a little bit different, is because there really hasn't been, hasn't had to be a slowdown because people have had extra cash to spend. Talking about momentum, um, so what this is a chart of is this is the U.S. stock market over the last few years, compared to the moving averages. So MA for moving average here, and this is kind of just saying, okay, well here's where the S&P 500 is today. What is the average over the last 200 days, over the last 100 days, over the last 50 days, and typically what we see, or what our technicians see, is when you see the market above these averages, it does tend to continue to go up, and when it crosses and them, and I guess it's intuitive that it would be that way, it tends to go down. So anyway, we're firmly above all the moving averages. And again, when you look at that and say, okay, well, when the market is above all its moving averages, what does the performance look like fast forwarding a year? And again, we see when the S&P 500 is below, the 200-day, the 100-day, the 50-day, the year tends to be not, and this is going back 60 years, tends to not be the best markets. Not always, but tends to be. And when we see the market, above all these averages, we do tend to see a good, solid future year. Now, I think again, getting back into like sort of the tech stocks, and why this market's doing so well. So when you look at these seven, the largest companies, and again, they're no longer the largest seven. I think Tesla's now 10th now. But again, we've got Google, Amazon, Apple, and Microsoft that we own. And then Tesla, Meta, which is Facebook, and Nvidia. They've done phenomenally well, 32% this year. Double the return of the S&P 500. And if you take those seven companies out of the S&P 500, only about 8.4% of the year, and basically flat for the quarter. So it's really been led by those seven companies. Now, the S&P 500 is an index of the 500 largest companies in the U.S. And it's cap weighted, meaning that the larger a company is, the larger, so the higher the stock price goes and the more the company is worth, the bigger position it dominates in that index. And so those seven companies, now, make up about 30% of the S&P 500. So the other 493 companies make up 70%. And so it becomes really interesting when you start comparing the two. And it's even more interesting when you look at them specifically. So, we own Google, which is up 27% this year. We own Amazon, which is up 21% this year. We own Apple, which is up 16, and Microsoft, which is up 16. Again, compared to 32. Tesla is up 0, and it's a company that we continue to look at again now because it has been lagging. Meta, Facebook, again, up 34, so doing okay. But the one that's really just kind of, I would say, out of control is Nvidia, which is up 142%. And so and just keeps getting bigger. And so when we talk about all this stuff historically and look at the markets, it's comparing, how how these companies are you have to take it with a grain of sand, I think. And I get asked a lot about buying Nvidia. It's a company we owned in the past. It'll probably go down in history as the worst mistake I ever made, selling it after it doubled off the bottom and thinking that it was a good time to get out, and then watching it just continue to go. But it's a good company. but it makes me really nervous. And I think it is, certainly responsible for, certainly responsible for a lot of the reason why we're seeing these, big market returns, and why we're seeing all these like green flags from the market. And this is sort of a picture. I have to explain this a little bit. Um, but what we've seen, the top is looking, or pause 1 second here. So what this is comparing is the market cap weighted, so the S&P 500 as it actually is, so as it's reported. So as I said, the larger the companies are, the larger they are in the index. So this is comparing how the S&P 500 has performed compared to how it would perform if you just made all those 500 companies equal. So each of the 500 was an equal piece in that index, and so that difference right now is 20%. And so just looking at like how I guess extreme that is, when you look at how vastly different that is, the last time that did happen was unfortunately the tech bubble. And so that's I think kind of that's enough to make you go right, and certainly keep an eye on it. So we have trimmed our tech positions the whole way through. But the fact that this is so divergent, it is a unique time, and so we have to be really careful. And it's also why having active management, having not just being passive and owning the indexes, I think really makes a lot of sense. And having an investment manager, pay attention to that is extra important. And then I guess just looking at sort of the go forward, I like this chart because it kind of looks at what we've been through as far as stocks versus bonds, and again why we continue to like bonds and why we continue to favor that balanced approach. The first quarter was it was all stocks. This is a ratio comparing stock performance to bond performance. So clearly for the start of the year, no question, bonds weren't there. And again, this this is global stocks. This isn't just the U.S. This is U.S., Canada, Europe, all stocks in the world, all the largest companies in the world. We tend to see this in the last quarter. It's been more of a balance, and that's with the U.S. tech outperformance and everything else. So I do think there's I do still believe in fixed income. I think that for us specifically, when it comes to earning our fees, it's an area where we can really do a lot of good work. And so we continue to focus on there. And yeah, and so I don't know why I always feel like I have to defend fixed income, but I do. So again, balanced approach, looking at sort of MBS recommendations. U.S. equities. We do have more in Canada right now. Like, so we don't follow this to a T. We are actually overweight in Canada versus the U.S. But being invested in the U.S. Is the recommendation right now. And that's largely because of the currency. We continue to expect to see the Canada cut rates faster than the U.S. And so that we'll see. Owning U.S. currency is probably not a bad place to be. So having more favorite U.S. investments over Canada. Duration is basically longer term bonds. So having those like 20-year longer bonds, the bonds that are going to really see that uptick when rates come down, that's the favored strategy. Alternatives, that can be a lot of things. For us, it's basically gold. So having some of those non-market sensitive assets in there. Emerging markets, again, neutral now. It was negative. So, a neutral position for National Bank and emerging markets is about 3%. We're at 1.5%. We'll revisit that. I always feel like I'm chasing emerging markets, so always hesitant to kind of continue to chase it, but it does seem to be making a bit of a run. So I'll sort of end it there and leave it for questions next. And maybe I'll turn off this slideshow and just go to me. Whoops. Stop presenting. There we go. That'll be big. And open up to questions. And you guys are muted at the boardroom there if you're trying to talk.
Great. Thanks, Jeff. There was a lot of information there. Do we have any questions? If you do, please raise your hand and we'll unmute you so that you can ask the question.
There's a little button, yeah, like in the top right, it has a little hand raise thing there. Or does anyone on the team have any questions?
Jeff, can you hear me?
I can.
You touched on US interest rates briefly. Bank of Canada decision on Wednesday. Do you have any insights as to where that's going for Wednesday and maybe the rest of 2024?
I think that Canada has, thanks, Zach. I think that Canada's in a position where it makes no sense to keep rates high when we're seeing in inflation at levels lower than the US, and we're also seeing employment numbers that are weaker than the US. And I didn't get into employment numbers, but they are starting to turn negatively in the US, which is again also why I expect to see them bring rates down. But Canada has started to struggle with employment a bit earlier than the US did. So that's I guess the expectation for this week would be that we could see another cut. The US, the expectation is the fall, and over the next sort of 16, 18 months, it's expected to see US rates come down about 2%. So eight cuts. And so, for Canada, because we're so closely tied to the US, obviously, if they're cutting, we have to as well. But in this case, we really should have. And I think that, I think it's tough in Canada because, there's such a battle against housing, right? And housing's such a big political issue. And anytime rates get cut, it seems to be a big push up. I think what we've seen this last spring is we saw a rate cut, obviously, and looking at sort of the real estate data, at least in the major areas, it's been pretty quiet. It's actually been a bit negative, and so I think that also provides good reasoning, I guess, for the Bank of Canada to be able to cut rates again, to say, hey, you know what, we cut them. It didn't have an adverse effect on housing, so we can cut them again.
Thank you.
You're welcome.
Very well answered. I do have another question.
I'm glad. Thank you, Zach.
Yeah, you're welcome. It has to do more with tying in with US politics. If we see a Republican win, are there certain sectors or industries that you think could benefit or maybe weak if Trump gets reelected?
It's a very good question. I think healthcare is probably the biggest concern. We have the Harvest Healthcare Leaders ETF, which owns all the largest healthcare companies in the US. So I think that would be adversely affected. I guess the obvious one, if there was a Republican win, would be defense. That's traditionally done quite well. We don't really have we've had defense contractors in the past. We don't really have anything. We had the last one. I'm trying to remember now. I think it was a Raytheon we owned, leading into the Ukraine situation or Ukraine war. Which we sold out of after it kind of bounced up. So we could look at that. I don't know. Defense companies are always tricky because it is an area where from a client, we try to manage from what's the best companies, but it is an area that does rub a lot of people the wrong way as well. But I guess I would say that when you look at the historic trends, especially when you get a Senate and House that are both controlled by one party. It does tend to be a market positive, whether that's blue or red. And so I feel like the last 4 years administration, it's been positive certainly for the tech industry. So that's another area where that I guess that could be thought about that, but that could be another sort of headwind to this major tech rally we've had. But my general view is, I think markets tend to be weaker leading up, and people trying to make guesses of what's going to happen. And then, once there's sort of a new administration in, and I guess there'll be a new administration either way now, excitement builds for the future, right? We get really excited, and the markets are, I always say this as well, the markets are, I used to say 50% human emotion and 50% math and analysis. And the longer I do this for, the more that shifts. And I think they're probably 60% or more emotional and human based now. So just that idea of like, oh yeah, like, good times are coming, and and I think that who knows what's going to happen if the Republicans win, but like they that that you could see that come from the markets, but again, I think from our perspective, I really believe the balanced approach is just absolutely the best approach right now. When I look through all those the companies we own, I think in the U.S. especially, it shows that we have some companies that are just crushing it. And then we have a huge group that's not, and it's not getting carried away with what's working. It's that approach to say, okay, some companies are going to do better sometimes, and some are going to do better others. So that's really like a really long-winded way of me explaining that I have no idea what's going to happen, Zach. So
Thank you, Jeff.
You're welcome.
Jeff, just another quick question. Do
Sure.
you anticipate a economic slowdown in the US and then that impacting the portfolios and the markets going forward, just based on expectations that the market's currently built on?
That's a good question. There could be, again, I'm talking about the fact that markets are priced for perfection. The fact that a lot of the momentum that's built into the markets, that's getting people to continue to add to their portfolios and buy equities confidently right now, is driven by those like Magnificent Seven companies. So there's a lot of things. There's always a lot of things to be afraid of. It's funny, like whenever things are going wrong, people are always like, oh, well, we should wait for it to get better, wait for this to get better, wait for that to get better. And 16 years, there's never been a time in my career where things have been good. So there's always concern. There's always something that could go wrong. For us right now, we've got, we're 59% invested in equity. In our balanced model, we can go as high as 65, which means that we do have like an extra, 6%, or call it, 10% more equity, increasing the equity weighting by 10%, or 6 into 60. So we can get a lot more aggressive, and that's generally my feeling in the market. I do follow sort of that behavioral approach to investing where it's looking at those as opportunity. You look at market pullbacks as an opportunity, right? And certainly we monitor the portfolios day to day, and there's things that come up that we need to act on. If we see trends changing, if we see, like preferred shares, they're getting carried away, we think they're to come down, or if we start to see, tech sentiment shift, and we need to make adjustments there. But overall, I'm an optimist. I have to be in this job. So when I see, risks, it's more like, okay, if and when things do go wrong, number one, are we in a portfolio that can handle it? And, you know, that's always number one. Like I just wouldn't be able to manage this much money or sleep if it wasn't. And so I feel really comfortable. Like we have, you know, we've got a good diversified portfolio in different sectors um, that they can, you know, really hold up well in a down market. I that's what I believe. And if it doesn't, then we'll make adjustments. But it should, and it's proven itself in the past too. And you know, I do really see those, you know, if we do see a recession, if we do see some major surprises, and you know, we see the performance from this year start to degrade, you know, it's protecting that performance and then, you know, benefiting from it. And, you know, that's always been where we've seen, you know, this year is kind of special because we really nailed it with preferred shares. We nailed it with gold. We nailed it with all the energy investments and material investments. But typically, like our group's performance has always come from doing well coming out of bad times. You know, that's where our outperformance has really shown itself over time. And so I think it'll always be that way. And so my answer to that question, Anissa, is always, you know, I look forward to those periods because it's like everything, it's like Black Friday shopping, right? Everything's on sale. So we'll see. I don't know. We're prepared for it.
Okay, perfect. Any other questions before we wrap up? Okay, great. Well, thank you everyone for joining, and we'll see you in about 3 months.
Perfect. Thanks, everybody. Have a great rest of the
Take
summer.
care, everyone.
Take care.
Bye.